as Katja said, I'm from Beauhurst. We're a market research firm tracking startups and scale-ups in the UK. The core of what we track is their equity transactions, but we also collect other information around those businesses. And we provide this information to our subscribers mostly through an online platform, but also we write reports. So we've just had one come out in trends in the equity market, and these are quarterly. So without further ado, start. So these are sort of the headline figures for 2015. This is the first year that we've looked at unannounced fundraisings as well as announced fundraisings. So announced fundraisings are these that have some kind of public source or press release. And unannounced fundraisings are ones that we've been able to verify through looking at regulatory filings. So in 2015, we saw over 4.9 billion invested into UK companies in equity finance. And of these almost 3,000 transactions, 1,640 of those were actually unannounced. So that's quite a large number, I'd say. And just an interesting bit here, the largest single transaction this year was £205 million into Immunocore, which is a biotechnology company from Oxford. The lead investors were Woodford, who are interesting. I mean, I'm sure many of you know of Neil Woodford. New entrant sort of into the kind of growth equity market. So we'll talk a little bit more about the unannounced fundraising data for this year. So as I said before, 56% of these fundraisings were unannounced. So this shows that the equity market actually, it's just the tip of the iceberg, the announced data that we're seeing. But only 16%, so I should have said that that's by number of deals, and only 16% by investment amount, which makes sense because obviously some of the larger rounds are more likely to be announced in press releases and for marketing by larger funds as well. So the reasons for this are probably that it's smaller angel rounds, family and friend rounds that aren't being made noise about. That's not to say that they're really tiny, these rounds that we're not hearing about. The average investment size for an unannounced deal was £460,000, which isn't insignificant. You can see the distribution there. So the vast majority of these unannounced investments were under £500,000. But and obviously it gets less, but there were a handful over 10 million, which I think is really interesting. From the rest of what I'll be talking about is announced deal data, because we've only got the unannounced figures for 2015 at the moment, so we can't compare with previous years, obviously. So you can see here that up to 2014, the number of deals was growing. It was double-digit growth year on year. But from 2014 to 2015, we only saw 3% growth by number of deals. Explore some of the potential reasons for that later. But the amount invested did grow significantly. So we're seeing more money going into a smaller amount of deals. The biggest driver for this drop in the number of deals was there. You can see 2015, and especially the second half of 2015, there was a huge drop in the number of deals at the seed stage. So this is the earlier stage companies. The venture stage companies saw decent growth. It was a 9% growth by number of deals. And growth stage investments stayed fair, decent amount of growth. But by investment amount, each of these grew fairly significantly, especially at the growth stage. Probably the main driver for this drop in seed stage investment was institutional investors moving away from these early stage investments, and equity crowdfunding, although it's taking more and more of these seed stage deals, couldn't quite pick up the slack, we think. And that's not to say that the money going into seed stage is any less. So you can see the average deal size at the seed stage grew, especially in the fourth quarter, corresponding with that big drop in deal numbers. So this looks like it's the remaining players in the market putting more money into those companies. On sectors in equity investment, they stay fairly static. So we've had the same 5 by deal number since 2011. Technology is always taking the large amount of deals. So for this year, that was 35% of all announced equity fundraisings. The second largest sector is always business and professional services. And then we've got industrials, media, and leisure and entertainment doing fairly well. Leisure and entertainment, I think, growing a little bit, probably, well, potentially due to the fund raising on equity crowdfunding platforms, where a lot of it is famously into sort of food and drink companies. The investor types, typically it's always the VCs and the private equity firms that do the large majority of equity deals. But the most interesting trend that we can see over time is really the growth of equity crowdfunding platforms. So this year, that's a 46% growth from last year, which is really significant. It only continues to grow. And potentially this year, that might be at the expense of private equity and private investment vehicles, which are down by 11% and 18%. This could also be those VCs and private investment vehicles, which kind of covers family offices as well, putting their money into crowdfunding rounds. So like the syndicate room model, where often there's a large amount of money before the crowd comes in. And by geography, London is really the dominates. This is a heat map of investment activity through 2015 in the UK. So yeah, London is really the key player, and then South East is rather strong as well, obviously due to Oxford and Cambridge attracting a lot of investment money. The North as well, but quite a lack here in the middle. Probably the most interesting is that graph on the side there, where you can see that London is just taking more and more by both deal numbers and investment amount, climbing almost to 50% this year, whereas it was all the way down at 35 back in 2011. Not sure as to the reasons for this. If anyone has any ideas, I'd be glad to hear them. And just as a last thing here, so we also calculate valuations for the companies at the time of the fundraising using the actual filings. And you can see here how as the fundraising, I'm not sure if you can see these numbers, but those are intervals of 1 million, starting from below 1 million and up to 25. The number of deals it decreases drastically. It's almost a power law decay curve. So that points to how hard it really is to do deals at a higher valuation. I mean, of course, we all know that companies fail, but sorry, I think we've skipped, yeah. So some of our predictions for 2016 say that, judging by the dip in seed stage activity, we don't expect that to grow much, especially if it's due to risk-averse investors moving away from the early stage market. It'll be interesting to see how venture stage companies do, if they're going to continue taking more and more of the deals from the seed stage. Actually, it's interesting, at the venture stage, although the private equity and VC firms are the most active investor type, seeders and Crowdcube were the top investors. So this could be a sign of crowdfunding moving on to higher deal numbers, larger rounds as well. And growth stage investment, we expect to continue to grow at the modest rate that it has. Some of the bigger challenges for the equity market to come, if this drop-off was due to risk-averse investors, then that could be something that we might have to be a little bit worried about. Potentially the overheated valuations in crowdfunding could make it harder for those companies to raise investment in later rounds, and if they might have to take down rounds, which, as we all know, isn't a great sign for the future of a company. And also, I think, very topical, Brexit. We noticed a real decline in investment, equity investment in Scotland before the referendum. And this was just mostly due to the uncertainty. We think people were afraid to make investments before they knew what the outcome was going to be. So we're predicting a little bit of a slowdown before we know what's happening with Europe. And of course, if it does happen, then there'll be a lot of difficulties for growing businesses, not least the loss of access to the single market, which might make it a harder sell to investors when you're raising finance, and also the loss of EU funding, both the grant funding and the institutional money from the EIB or the EIF, the Investment Bank and Investment Fund, that goes into a lot of funds in the UK. So that's it. Any questions, comments?